If you were a farmer and you had the choice of buying your seed in the springtime and getting a tax break on the price of the seed, but later on when you sold your harvest in the fall, you had to pay tax. That's a traditional IRA or 401k. What if you could just pay tax on the price of the seed, and later on in the fall when you sold your harvest, you could do that with no tax? Now, you may think that's a Roth. What would you prefer? I'd rather have the tax break on the harvest. But see, most people think they're going to be in a lower tax bracket when they retire. In fact, 91% of Americans opt to pay tax on the harvest rather than the seed. It's sort of like looking at a sumptuous Subway hoagie sandwich here depicted here on the left. IRAs and 401ks. Look, it's growing to a large sum, but later on when you go to retire, the IRS comes in and performs a major cashectomy on this thing, and it looks like this unappetizing sandwich on the right. Why is that? Let me illustrate here on the screen and the whiteboard. Folks, let's say that you were age 60 and you were going to take one last stretch towards retirement. So at age 60, for every $150,000 you had in pre-taxed IRAs or 401ks, or even if you earned $150,000 that you wanted to sock away, that is 100 cent dollars that you're socking away, $150,000. Now, let's just use 10% as a hypothetical rate of return because it's easy math. That means by the time you were 67 years old, that would double to $300,000. Now you're ready to retire, and let's say you're earning 10% on that. You could pull out $30,000 a year, but you have to pay tax on that. Between federal, state income tax, FICA, Medicare, tax, you, let's say, pay a third of that in tax, which would be $10,000 in tax. You're only really netting what? $20,000. In other words, $300,000 isn't all your money. It never has been. 1/3 of that belongs to Uncle Sam. Your net value, if you pulled that all out in one, fell swoop, would only be $200,000. That's your portion. $20,000, you're getting 10% on your portion. Now, a lot of people say, well, I want to put money in a Roth. So you pay tax on the seed money. So that $150,000 means you'll pay tax of 1/3 of that, or $50,000 out in tax, and you only have a net of 67 cent dollars, $100,000 to set aside in a Roth. That doubles at 10% to $200,000 in this same 7-year time period. You're earning 10% on that, and you pull out what? $20,000 a year, but that's tax-free because it's a Roth, correct? Do you notice something here? There is no difference between a traditional IRA or 401k and a Roth. This produces a net of 20. This produces a net of 20. This is worth 200. This one really is only worth 200 net because of the tax effect. So folks, there is no difference provided what? That taxes don't go up. Most people thought they would be in a lower tax bracket, and that has not been axiomatic, again, for over 25 years. A Roth, I can prove, is probably at least 33% to 50% better than a traditional, but I don't own an IRA or 401k, nor a Roth. There are far better ways to save and accumulate money tax-free. In fact, in other courses, we actually show you how to have $50,000 recouped. So you have $150,000, it doubles to $300,000, and that $300,000 earning 10% more predictably gives you $30,000 a year tax-free. How much more is 30 than 20? That's 50% more net spendable income. So let me ask you a question. Will future tax rates likely be lower, the same, or higher? If you're like everybody else, oh, they're going to be higher, then why do we want to postpone tax to some future perceived unknown advantage and have a huge nest egg and then pull it out when we're convinced taxes are going up? You know, oftentimes young people will start a job and open an IRA or 401k account, and they start reading the fine print. Caution, must wash with tax before use. Will shrink 33% because of tax. Maker recommends being taken to the cleaners. Why? Because here is this young man at age 59 and a half or age 70 and a half, and that one size fits all advice doesn't fit.